We work hard as physicians to take care of the health and well-being of our patients. But when it comes to our money, do we have the same condition of care? Probably not. Let's change that together. Welcome to the Financial Freedom for Physicians podcast, where we'll fight and advocate for your financial literacy. As always, I'm your host, Dr. Christopher Liu. Thanks for being here. Let's jump into the show. Hey guys, I want to welcome you guys to the Financial Freedom for Physicians podcast. We've got a great episode this week. Before we begin, please hit the subscribe button as well as the notifications bell, and be sure to like, comment, and share if you like this episode. And we'll get into this week's sponsor and show. This week's episode is sponsored by CitiVest. CitiVest has quickly become the most popular and best way for doctors to invest in top-performing real estate private equity funds that are usually reserved for institutional investors. This unique access to investing in these institutional funds is available for the first time ever through CitiVest's easy and secure online investment platform. CitiVest does the hard work of conducting due diligence and vetting the investments. They even get a third-party due diligence report that is posted on their website. As a result of aggregating a several $million investment amount into their access funds, CitiVest gains access to investing in the institutional investment and is able to negotiate better investment terms such as a 12% preferred return. You can check them out at citivest.com or go to the link in the show notes below. Now on to the show. So welcome everybody to this week's podcast episode for the Financial Freedom for Physicians podcast. And I'm your host, Dr. Christopher Liu. And as you know, we tout 4 types of freedom: time, location, emotional, and financial freedom. And initially, when this podcast started, we focused on physicians, and now it's grown to where I'm sharing it, bringing guests from all walks of life, entrepreneurs, business owners, investors, syndicators, so that the audience collectively can benefit from our sources of wisdom. So today we have a special guest. His name is Chris Odegard, and he is the founder of the Prolific Investor Challenging Conventional Wisdom. And he's all about passive investing through real estate. And just a brief overview before we introduce him: he's an alternative investment blogger and educator at theprolificinvestor.net. He's the author of Get Off Your Ass and Manage Your Money: Why You Need Alternative Investments. And he's a teacher and educator, talking about 401ks, talking about increasing your annual returns that are less volatile, producing cash flow, tax efficiency with diversification. So I'll let him talk about himself. And so without much ado, Chris, welcome.
Thanks, Dr. Liu. Appreciate you having me on. It's a real honor. I'm looking forward to talking to your audience and talking about passive investments and building wealth.
Awesome. Yeah. We were just talking backstage, and, like a lot of physicians, we have high income, we enjoy our jobs, but we just need a place to park our money where it's safe, it's secure, it's not prone to all this volatility, provides cash flow, passive income, tax advantage. So tell us more about yourself, how you got started, and your company.
Yeah, so I started off as I grew up in a family of employees. For anybody who's read the cash flow quadrant, I was an E. I was raised by E's, and that's kind of all I ever knew. And I was taught to get an education and get a job with benefits and work there forever and put your money into the company's 401k plan. And so that's it's what I now call the 401k highway to mediocrity. So I did that for a lot of years. And then unfortunately, something happened in my mid 40s. I lost 55% of all my assets and thousands of dollars a month in cash flow due to an illiquidity event. And so all of a sudden that mediocre path just got even more mediocre. And coincidentally, about the same time, a friend had said, "Hey, Chris, you should read this book." And I did what I did with a lot of books. I put it on the shelf until it stacked up for a while. And I finally picked it up and read it, and it was Robert Kiyosaki's Rich Dad, Poor Dad. And like millions of others, I was my mind was open to a different way of investing. So I started going down that path pretty fast. And I think probably like a lot of people that venture down, you try a whole bunch of things. There's kind of the shiny object syndrome. And so there was, single family rentals and multifamily, and there was notes. And I finally ended up really liking the syndication model as a limited partner, just completely passive. You make good returns, and in real estate, you get all the benefits of real estate ownership, but you've basically hired a professional in the form of a syndicator, to manage this asset that you're part ownership of. And shorten the story a little bit, 9 years after I had that illiquidity event where I lost 55% of everything, I had made up all the losses, multiplied it many times over, and I quit my job, and I never have to work again if I don't want to. And now what I like to do, which is to educate people of all walks about a better way of investing and getting to financial freedom or retirement a lot faster.
What an amazing story. So now you have time, financial, emotional, and location freedom. So truly. When I was listening to one of your podcasts, I heard you talk about that. And it's way more eloquent than what I have talked about. I have always said that, what if we could just take money off the table as a worry for people, whether it's COVID or whatever it is, if you could just take that worry away, all the other dominoes kind of fall in place, and it's kind of a precursor to the time, location, emotional freedom. You got to get money off the table first as kind of a worry, and then the other one should come quicker, I think. Yeah, absolutely. Yeah, it's so interesting about, the whole idea of freedom from the industrial age now into the information age. So, so tell us more, like in terms of, because I know, real estate is a very broad thing. So what are some of the differences between active and passive real estate, and what are some of the advantages of syndications?
Sure. Well, that ties right into a blog article, which I was planning to publish it last month, but I will publish it this month for sure. And I compare 3 different ways to invest in real estate. And one is, what I call the single family rental do-it-yourself. And a lot of people start there. The kind of the cost of entry is low. I mean, you purchase a single family rental, you manage it, you do everything yourself. And then the next way is a single family turnkey, where you find a turnkey operator who specializes in single family rentals, at a good market in the United States. And then the third way, and these are not the only 3, but these are just kind of 3 ways that are, pretty available to most people, is, investing in syndications as a limited partner like I do. And as you move left to right across those scales, something really interesting happens. Your highest risk is really on the left side with the single family do-it-yourself, because if you haven't really done the study and the homework, you could get it wrong. And, real estate is illiquid. So, your risk there is pretty high. Now, if you move across to the next path, which is the single family rental turnkey, now you've basically, kind of like the syndication, you've hired somebody who's a professional to manage that single family rental. And then the same thing with the syndication. And you could get into all 3 of these investments for $50,000, certainly lower in some places in the country with the single family rental or turnkey. But one of the interesting things is the returns. And these numbers came from an actual turnkey provider and a real property that was for sale. On the single family rental, let's say you might make about 11% annual return on your investment, doing everything yourself. But you've also now got a second job, right? Because you're pretty much doing everything for this rental. And for your audience of high paid doctors, they don't need a second job, right? So and then you move over to the turnkey, and your returns go down a little bit, like maybe from 11% to 9%, because you got to pay them to do this stuff. Now you go over to the apartment syndications, and I have never had an apartment syndication make less than 20% average annual returns. So to me, it's the only way to go. You kind of have the lowest risk. If you pick a great syndicator, you have the best returns. You get all the tax advantages, and once you've wired your money off, you're pretty much out. I call it. I like to send my money out and have it come back in about 36 to 40 months with twice as many friends. So those are kind of three ways to do it.
Mm-hmm. Now, what? Because I know, we have people in the audience never invested in real estate. Some of them are just homeowners. They, some of them are landlords. And what qualifications do you need to get into syndications? Do you need any experience to get?
Well, so there's two. There's a little thing called accredited investor, which the SEC came up with, and so in most syndications, you need to be a accredited investor, but not all. And that just an accredited investor is someone who has a net worth of over $1 million, excluding their primary residence, or an income of, I believe it's 200 as a single person, or 300 as a joint filer with a spouse. Uh-huh. But even if you don't have that, there are syndicators out there that will accept some number of non-accredited investors into their deals. Matter of fact, I have a relative who's going through this right now, and I steered her to some resources where you can more easily, identify these people. Then you set up the conversations and get comfortable with somebody, and then it's just a matter of, okay, well, when's their next deal? And so, yeah, it can be done.
Yeah. Are there any risks that people need to be aware of if they go the accredited investor route versus the non-accredited? So like, is the sponsor quality less with the non-accredited investors? I'm sure people would be asking that question.
That's since I haven't done anything like that as a non-accredited investor, that's a good question. Uh-huh. I think in general, for conventional investors that, invest in the stock market, when you compare that to alternatives like real estate, there's one element of real estate that's riskier. It hasn't gone through, and that's why this accredited investor rule exists. These things are unregulated. Anybody who's got $15,000 to hire a lawyer can set up, what's called a private placement or one of these syndications and say, hey, I'd like to have some of your money so I could go do this. So it's easier in this space to get hooked up with a bad operator. So you have to be careful. I think that's across the board, whether they're accepting accredited or non-accredited investors. In the stock conventional area, it's not like it's foolproof. I mean, we've heard of the Enrons and Volkswagens and Wells Fargo. So it happens there, but I think it could happen easier over on the alternative investment side. So you really just have to pick a great syndicator. And I only go with people who come with recommendations from people a lot of recommendations from people that I know, like, and trust.
Yeah.
And it has a track record. One of the syndicators I use has been doing this for, I think, about 5 to 7 years. And they have a track record of delivering 30% average annual returns to limited partners. Mm-hmm. So you're looking for somebody who's done that. You don't want to, I don't think you want to, be their first in their first deal. They're going to have to do that with somebody else.
Yeah, exactly. Yeah. Track record, trust in good sponsor. That's, do your due diligence, do your own research. Don't lose more than you can afford. Yeah. And so another, this is great. This passive real estate and syndications. It's a great way for the busy high income individual to build their wealth. What are some of the risks, especially in today's economy, if people are interested in getting started in this, they should be looking out for?
Well, we're in a very interesting time now with, the price of single family rentals being high, the price of apartments being high and the cap rates being low. Mm-hmm. And, if you go out and, you could follow 10 or 15 people in the industry who theoretically know about this stuff, and you get 10 or 15 different answers. I was just at a get together, and the Syndicator, one of the founders of the company, was there, and they're still buying apartments today using the same criteria that they've been using the whole time, and they're still finding stuff And what that means is like, hey, they've got this box, and if this apartment building, all the factors fit into this box, it's a buy, and they will buy it, and they know they can make money. And they are still finding those in today's market. Now, they're not finding as many of them, but the point is that they haven't had to go out and change their criteria to match the marketplace. They have a business model, and they say, we know if we can find buildings like this, we can make money for ourselves and our investors. So I'm voting with my dollars and continuing to put money into apartment syndications.
Yeah. So we're definitely living in interesting times. The other day I was looking at the mortgage rates. They're almost like 4%, 5%. With all this inflation, and then a lot of development, and it sounds like they're saying the housing prices are overinflated. So are we doomed for 2008 or something similar? It's hard to say, but I guess Yeah.
Well,
So
I can talk about 2008 a little bit, because when I was still doing my own single family rentals and small multifamilies, all through that 2008, yes, the values dropped dramatically, but they were positive cash flowing properties. And as long as I didn't need to sell them at those values, I had tenants, I had increasing rents, and you just wait out the storm and the values came back eventually. So I've kind of been through that and seen that happen. So I feel like, at least for me, I'm working with some really smart people, and they're still finding, these deals that they believe will work. And, when they tell me that we've come to the end of that road, then there'll be other opportunities that really smart people will figure out.
Yeah, especially with real estate, there's a market for everything. Old strategies may not work, or old strategies may only work in certain markets these days. So it's definitely not one size fits all approach. You have to sort of tailor it and adjust your risk, and so it's really an interesting market, and very dynamic.
Yeah, and every market is different. I mean, this particular company is only working in about four to six cities. Yeah. I mean, they look at hundreds of deals, and before they actually, find one that works for them. So, there's just some markets that across the country that just aren't working for just about anybody. As an investor, if the numbers work out, especially with the cash flow, the net operating income, the purchase price is decent, and you're not over leveraged. If you do get caught in a downturn, if the numbers still work out, you're still okay. You just weather it out. But like I said, 2008, they were over leveraged. The numbers didn't work, and it was just big mess. So. It's a different situation now. That doesn't mean there's not risk out there, but it is different for sure. Yeah, definitely. Well, this has been a fantastic conversation. I know a lot of listeners on the show are interested in hearing more about you. I know you do a lot of blogging, your book, interested in what you do. So what's the best way to contact you, get a hold of you, to find out more about you and possibly work with you? Yeah, the best way is just to go to the website. It's theprolificinvestor.net. And there's a handful of ways you can interact with me. One is you can subscribe, so you get notified every time I publish a new article. You can there's a link there to pick up the book that'll take you directly to the Amazon link. You can take the Conventional Wisdom quiz, which is a 10-question quiz, which will test your knowledge on conventional stuff and alternatives. And you can also book a free virtual 30-minute coffee with me if you want to, get past the books and the articles and just talk about what your situation is. And so, everything's at theprolificinvestor.net, and all the social media things, the articles, the videos. I have a lot of resources, different companies that I use or come highly recommended. So that's the one spot. Awesome. Well, thanks so much. And, this has been a fantastic conversation. For all the listeners out there, we'll provide the resources in the show notes. And till then, we encourage all the listeners to go, visit Chris's website, find out more about him. And so thanks so much. And we look forward to having you as a future guest in future episodes. Great. Thanks for having me on. I was honored. What a fantastic show. I hope you enjoyed our very special guest.
Just remember, as a shout out to our this week's sponsor, CitiVest.com. CitiVest gives you access to the best real estate private equity funds with enhanced investment terms, verified due diligence, and lower risk. You can check them out at CitiVest.com or click on the link in the show notes below to hear about their upcoming investment offerings. I'm excited that you made it for another episode. You are truly the best. If you've been following the show for a while, you know that my passion is to bring you the education you need to find your path to financial freedom. Please come back week after week for new content, new resources, and great guests. Until then, if you haven't already, please be sure to check out the website, www.drchrislumdphd.com for more support. I'll see you next week.